Rahul Bhasin joins us, managing partner with Bearing Private Equity Partners. Rahul, good morning. Thank you for joining us. Markets at an all-time high, economic indicators at a record low. Nobody's excited about spending, yet consumption stocks are trading at P multiples which are highest in the world. So I'm just trying to understand here who will get it right, who will get it wrong. Will the economists get it right, or will market investors like you get it right?
My experience has been, Nikunj, is that markets are far smarter than people give them credit for. Of course, there's distortions and people get carried away at times, but I think that you have to look at valuations and you have to look at that in the context of the fact that I think the cost of money today in the whole world is lower than it's been in the last 1,000 odd years. If you look at almost any of the reserve currencies in the world, whether you talk about the US, you talk about Japan, you talk about most parts of Europe, you'll find that everybody has got a very strong monetization program going in some form or fashion, and interest rates are at very low levels. Right? And if you have cost of capital which is that low, I think that's been driven by policy, then you will have a situation like what you have currently, where asset prices will look very pricey in any historical context. But if you take that discounting cost, you will find that they may not be that unreasonable. I think in an Indian context, it's quite interesting that we've had the highest cost of capital in the world, probably in real terms, over the last 5-7 years. And for those companies and those stocks and that part of the economy which clears on the domestic cost of capital, you'll find that valuations are cheap. That's largely the mid caps and the small caps and that whole segment. But the part which is fueled by money from the ETFs and from the global capital, which has a far lower cost, you'd find the multiples are very expensive. And I think that's the dichotomy that you're seeing in the markets today. And that gives opportunities for all kinds of players, whether you're a momentum player or a value player. I think it's a market for everybody at this moment.
A purist, I would say that if you buy stocks at P multiples of 50, 60, even 100 times, the returns will not be great. The new theory which I'm hearing is that if you are in a low interest rate environment, you cannot value stocks, because if earnings are going to be there and if interest rates are low, then don't get trapped into valuing stocks based on PE. Do you think we need to understand that something different is happening in the world? Because you bought stocks which cannot be called as very cheap stocks, and yet you've made money in a Manapuram, Marico, Emphasis when you invested in them.
In a market like India, where you can have compounding growth over many periods of a very extended period of time, and you can see or you can work with companies to gain market share significantly. So there's an organic market growth, there's a growth which comes from gaining market share. There are also growth and income which accrues because of productivity gains and essentially working with companies to reduce their cash cycles. You start combining all of these gains together, then what looks nominally expensive can organically work out quite reasonable over the long term. The issue is that, and the big challenge, and I think that's, I'm very lucky and very fortunate that I have long-term capital available, is because when you start doing any of these activities, what tends to happen is that you depress earnings in the short term. Which is why most of our activities tend to be more in companies which are private, not public. Because if you work with a company to increase their brand, you increase expenditure. If you put new IT systems in place or ERP systems in place, you increase their expenditure. You increase their quality processes, you increase the expenditure. You increase the just the entire HR processes and bring in more talent, you increase expenditure. So what tends to happen is that you buy what looks nominally expensive, and then you make it even more expensive on a short-term multiples perspective because earnings get depressed. But if you have a long-term enough perspective, you get the payoff from these kinds of businesses and these kinds of companies, and which is why Over, for more than 2 decades, we've compounded money at over 30% a year. So there is immense amount of opportunity in India for these kinds of opportunities. And look, some of the companies, you talked about Manappuram, for example. It's extraordinary. The company has phenomenal distribution. If you look at the number of transactions they do, in a day, it's larger than most banks in the country. And they have access distribution around the country. Their return on assets is 5.5%. And if you look at their growth rate is almost double of their P multiple today. So, obviously such businesses will do well, but it was a long journey for us. We've been there for a long time, and just working with the company to increase the platform of different businesses which have been built over the last 5-7 years. It's a journey that takes a lot of investment, takes a lot of patience, but you come out of it on the other side, right, and you tend to get a lot of returns, and it generates a lot of value for all the stakeholders.
Focus on what's happening in the IT space.
Even the consumer companies, my own belief is...
Sure. Do continue your point. Go ahead.
I'm sorry. Yeah, even in the consumer companies, my own belief is that a lot of the companies which have become very expensive now, you can see that a couple of things will happen. See, I think demand has been very artificially depressed at the moment. You're going through a transitionary phase, you're going through a lot of cleanup in the economy, you've had this negative wealth impact of real estate, and like I said earlier, I think that real cost of money has been extraordinarily high. And that has depressed consumption. From a long-term trend growth, you're actually way below trend. So you're not looking at peak earnings right now, you're looking at earnings which are probably, under trend earnings. So therefore, multiples tend to look higher. On top of that, you've had a lot of cleansing of the tax system, GST, etc., which will benefit the players who are better organized and better compliant, and at the cost of those who were doing business in a non-compliant manner. And I think a lot of these businesses will benefit. I think that you will see a similar trend even in real estate, for example, where you will have some handful of companies who've done very well. We have investments in the listed environment, in Prestige, in Brigade, which have done extraordinarily well for us because we felt that the entire sector, most of the weaker players will disappear in one form or fashion, and the larger players will actually gain market share and have very robust growth, and that hypothesis has worked out correctly. I apologize, I interrupted you. You were saying something.
We're going to take a look at the IT pack and get your views on whether you feel mid-cap IT in particular is starting to look attractive, given that the heavyweights are actually not showing that kind of robust performance, in fact showing a bit of a stress on particular segments. Would you still look into mid-cap IT?
Look, I think most of the mid-cap ITs which are standing today, which have not been rolled up, are quite well managed. And I think that the opportunity set in the global IT world is still very high. And I think the Indian companies still have a very robust cost advantage, and they have access to good labor. And I think those fundamental competitive drivers have not disappeared. So these companies will do well. You will not see that tearaway growth which was there 20 years ago in the sector, where companies used to double every year or every 2 years. But I think for the investor who's looking at the 10-15% kind of organic growth over the next decade, I think these companies will provide that kind of growth, especially the better managed ones. But I do think that the big opportunity, the disruption, is being caused by AI, applications of AI into different industries, and you're finding that you're already seeing disruption using these kinds of this kind of technology. You're seeing companies like Bajaj Finance, etc., which have built a huge market cap in the last decade or so by using and incorporating a lot of insights from these kinds of technologies. And I'm seeing this sector after sector, and the winner and the loser will get determined by in this fashion. If you look at Tesla worldwide, Tesla is a company which runs in an operating system, which is, if something goes wrong with a car, somebody in central Tesla, this thing can actually rejig the car and rejig different functions in the cars to optimize its performance better. And they actually capture the data of how the car functions in the conditions it functions and can fine-tune the car in that fashion. Now, this kind of activity, the capturing of big data to actually understand how you can optimize your profit margins and your business model, I think these are the disruptions, and this is where the large value creation will happen. Not in the traditional IT services kind of business. Though having said that, I still, like I said earlier, I think that they will still give you your steady 10, 12 kind of % returns over the next decade or so.
You think there is going to be a big earnings pool or a big growth sector which will get unlocked in this decade? And to add out to that, where do you see a combination of earnings growth and PE growth? Because that's the ultimate potent combination for an investor. Do you see that happening anywhere in the listed space at all, or everything is priced to perfection?
I did mention and alluded to some of the companies in our portfolio where the price earning multiples are significantly lower than the growth. So you're going to get inevitably PE expansion and the value of the growth. That inevitably happens. No, I don't think things are priced to perfection. I think it is a very narrow strip of the market which is priced to perfection. And that's really because of the arbitrage in cost of capital which is driving that kind of phenomenon. Lot of the small mid-cap companies are not priced to perfection. Of course, they're illiquid and it requires stomach of a long-term, for someone to take a long-term exposure, but there is tremendous value that we find all the time. There is also a lot of opportunities today, I think, arising from the government's very stated and my own senses serious intent to divest a lot of the public sector companies. A lot of these are very rich in terms of assets and poor in terms of productivity. So I think that, if you make a call and there's greater clarity arises as to which assets might get sold down, and if there's half decent management which takes over, which is better aligned, I think you'll find massive value creation in that entire ecosystem over the next decade or so. And I think that'll be fantastic for the economy and from the economy's perspective too.
All right. Thank you so much for joining us this morning. Rahul, great to have you with us as always, and do have a good weekend.
Thank you. Thank you so much.